ES Audio.
From the Evening Standard in London, I'm John Weeks, and this is The Leader. The UK is once again staring down the barrel of a recession as the Bank of England has again hiked interest rates, this time by 0.5%, as it battles to keep inflation down through a worsening cost of living crisis. The bank has predicted the UK will go into recession in the fourth quarter of this year, which could last into 2024. The interest rate rise is the highest for 27 years, and the Bank of England's also predicted energy bills will push inflation to 13%, up from an already 40-year high of 9.4%. Today, the energy regulator Ofgem warns that customers face a very challenging winter ahead, as it now plans to update the energy price cap quarterly instead of every 6 months. Experts predict bills could average up to £3,600 a year by January, but add to that a rise in mortgage rates as well as the costs of goods, services and borrowing going up, and it creates a dangerous financial cocktail for millions across the UK. So, how does the Bank of England expect this latest interest rate rise to help the economy? And how tough will it prove to be on people and families across the country? Joining me now is Economist Lukasz Krebel from the New Economics Foundation. So Lukasz, today we heard the news that not only are interest rates going up by 0.5%, but also that we're heading into a recession. Can you describe just how significant this announcement from the Bank of England is?
Yeah, every time now we have the new announcement from the Bank of England, the news keeps getting worse. So the path of change, unfortunately, is not a surprise in a sense. The expectations were already very grim, but nonetheless, it shows we are still not moving in the right direction, to the opposite of the economy. So for the Bank of England, the prediction of inflation going up to 13% now, where previously they were forecasting 11%, that's really bad news given their mandate. But also economy, as you said, prediction of recession. And that creates a kind of, very difficult tight spot for the bank, because the bank's approach of trying to respond to this high inflation is raising interest rates. That's their chosen policy tool. But when you raise interest rates, the very idea is to try to suppress demand in the economy. So it is actually pushing economy towards recession. At the same time, we are, facing the cost of living crisis spiraling out of control. So, it's a very tight spot for the bank. And I'm not convinced that they know the right response to that.
So what is the economic sense, the economic logic behind increasing interest rates? What are they trying to achieve with that?
Yeah, so the basic theory goes that we have too much demand in the economy. People basically have too much money to spend compared to the amount of goods and services they can buy. So the theory goes what the Bank of England needs to do is to make the costs of credit more expensive. So any type of credit like mortgages or consumer credit and so on. But by setting the Bank of England bank rate, so exactly the one that they increased today by 0.5%, is like the baseline rate for the whole economy. And if this rate goes up, then the cost of credit in the economy overall are also expected to react and go upwards. So through this mechanism, the Bank of England actually wants people and the companies to have less money to spend or being less able to borrow more to spend the money. So then, if that reduces the demand in the economy because people and firms have less money, you would expect it's harder for sellers to raise their prices. So that's the basic theory. But this theory is based on this presumption that there is too much money in the economy, that the wages are already rising at too high rate. However, the current inflation that we are facing is very much driven by different factors. So by externally driven factors. So not because wages in the UK are rising too fast. They are not. Any increases in wages tend to be way below inflation. So actually people are losing income in real terms.
And in terms of the interest rates rise, it looks like it'll be mortgages that will hit people the hardest. But what else will this rise have an impact on?
Yeah, so the most direct connection is through mortgages, to people on variable rates, because the contracts are typically written in a way that they directly respond to the Bank of England interest rates. So people who have this type of mortgage will pretty much immediately see increase in their costs. I mean, the second impact would be on more general types of credit, so like personal loans, business loans, credit card loans. So people may see, like, when you use your credit card, it may become more expensive by, again, 1% or 2 points. Or if you try to take an overdraft on your bank, there may be some increase in fees and so on. So there are a couple of elements. But I think, the more worrying part of all of that is actually the idea is, to suppress the demand in the economy, which in the end will result in lower employment. So Bank of England does have a projection that over time the unemployment will increase. Not fully down to their policy response, but that's one of the elements. So then when people actually lose their jobs because the economy goes into recession, that's what happens in a recession. People simply lose their jobs. I mean, they lose all their income. So some people will be disproportionately hit by that.
And so far, it seems like the Bank of England's main recourse for tackling inflation is just to keep hiking up interest rates. But that can't go on forever, can it?
Yeah, well, it really depends on, on the politics of the situation and, on perhaps prevailing mindset in the bank. So if you keep actually going on forever, at some point, it will cause a deep recession that, will have probably some impact on the price or slowing the increase in prices. You cannot control, the external price, as I said, but you can slow maybe some other increases if it causes a deep recession and so many people lose jobs that, the firms cannot really even recoup their costs. My sense is the bank actually does this because they need to be seen to be doing something. It's their mandate. Economically, the bank doesn't have such a control over inflation as this mandate would suggest. But because they have their mandate, the credibility is on the line. The inflation should be 2%, not 13%. They need to be seen to be doing something. And the policy that they have, or they think they have, is interest rates, while in fact, other tools of government policy would be more relevant.
So what could be done instead of this interest rise to help people and the economy cope better?
So again, coming back to what is really driving this inflation, and it's not wages, it's energy prices, and it's particular type of energy, fossil fuel energy and gas, fossil gas. Much of it in the UK is importing. So the right response would be to tackle that. So what the government can do and what the Bank of England would help with is look at how we reduce our reliance on fossil fuels and on fossil gas. So at New Economics Foundation, we argue for a Great Homes Upgrade. So this will be this program of massive housing retrofits, installation of heat pumps and so on. Electricity can be made cheaper using renewables, but most of all, simply insulating homes. UK homes have among the worst rates of insulation in Europe. So the Bank of England could look at introducing a dual interest rate regime. So let's say, okay, that, because of their modeling, their approach, they think that there needs to be higher interest rates overall in the economy. And maybe for some sectors that is the case, that we want to reduce activity for some. But then that means that the cost of credit will also go higher for people that want to take loans or businesses that want to take loans for green investments, for insulation, for solar energy, for wind farms, for all of that. So what the Bank of England could do is introduce something similar to what the ECB in Europe has been doing, a cheaper lending rate for commercial banks on the condition that those loans are extended to green projects or to insulation.
Let's take a break now. In part 2, economist and columnist for the Tribune, Grace Blakeley, explains why hiking interest rates will only make things worse.
If people are paying more to service their mortgages or to service pre-existing debts that they have, that is money that is going to be taken away from other forms of spending. Equally, if businesses are being discouraged from investment, that is going to exacerbate this recession.
I'm now joined by economist and columnist at the Tribune, Grace Blakeley. First of all, Grace, what was your reaction when you heard the news today about not only the interest rate hike, but also that we're heading into a recession?
I mean, the news about the interest rates was expected, but still disappointing, especially when combined with this news about us heading into a recession being driven primarily just by this stark increase in households' costs, which is preventing them from going out and spending and having a knock-on effect on the rest of the economy. And, that is why this interest rate hike is not going to work, because raising interest rates is supposed to reduce demand, primarily through the channel of making it more expensive for businesses to invest, but also through making mortgage repayments and other debt repayments more expensive and therefore discouraging borrowing. Now, the problem that we have at the moment is that households' finances are so constrained that adding any extra layer of costs is just going to make the problem far, far worse. If people are paying more to service their mortgages or to service pre-existing debts that they have, that is money that is going to be taken away from other forms of spending. Equally, if businesses are being discouraged from investment, that is going to exacerbate this recession, at the same time as not really solving the underlying problem, which is that energy prices are very high, and there are all sorts of ongoing issues around global supply chains and shortages of particular goods. So it's not going to solve the inflation problem, and it's going to make the cost of living crisis much worse.
And there has been criticism of this interest rate rise. What other economic solutions are there? Is there anything radical the banks or even government could do to get us out of this mess?
So, inflation is one of those very tricky problems, especially when it's being driven by cost pressures that kind of span the globe. There's not really anything that one government can do at this point in time to completely restrain the cost pressures that have emerged from the aftermath of the pandemic. What we can do, looking towards the long term, is start thinking about how we diversify energy sources to make sure that we have cheap, sustainable energy that is available to us over the long run. So that means investing in renewables. I think that's one of the biggest lessons to have come out of this crisis, to be honest. But over the short term, we need to make sure that we're protecting households, because ultimately we have this kind of shibboleth in economics, which is that, we just need to make sure that we keep inflation down regardless of the costs. But actually, what is the economy, in inverted commas, for? What are we doing all this stuff for? It's to make sure that we are prosperous, that people are able to kind of survive, that people are able to invest in themselves, that we're able to encourage businesses to invest, to create jobs and boost growth over the long run. And doing that requires creating some confidence in the economy that things are going to be okay.
And one way of helping people, in theory, is to give them money to spend, whether that's through wage increases or a lump sum to get them through the winter, for example. But by the same token, the theory is giving more money to people causes inflation to get worse. Is that the case?
Well, it depends. So, the real problem that we have at the moment is that corporate profits are very high. It's not that wages are too high. And what we're seeing across the economy, and particularly in sectors that are very highly concentrated, so where there are a few very big firms, is that prices are actually rising at a far higher rate than costs. And the result of that is these huge corporate profits. And now, that is basically extra cash that is being squeezed out of the economy and into the pockets of the very wealthiest. And, the inflationary pressure that then arises from that is significantly greater than any inflationary pressure that's being driven by wage increases, because actually most workers aren't seeing their wages increase in line with inflation. Most people listening to this will not be looking at, 15% pay increases at any point over the next year, which basically means that they'll be taking a pay cut. So the idea that we're going to see wage increases kind of locked into the economy because workers are so powerful that they can shut everything down and force bosses to give them pay increases is just utterly absurd. The problem that we have right now is bosses ignoring workers' demands for higher wages and just kind of creaming money off the top to put into their pockets and into the pockets of shareholders. So the wage price spiral argument is it's really kind of nonsense at the moment that people chuck out to just defend the status quo.
And we know the government needs to come up with more measures to help people, with promises from Liz Truss and Rishi Sunak of various tax cuts. Is this a good time to have this election of a new Prime Minister?
I do not have particular faith in either of these candidates to be able to solve this crisis, because the Conservative Party has been in power for a very long time now. And a lot of the problems that we're facing, including things like the long-term stagnation in wages that we had after the financial crisis, the long-term deterioration of lots of our public services that we're seeing at the moment, and also our failure to have invested in renewable energy, which would have protected us somewhat right now. All of those things are down to Conservative Party policy, as is the fact that we've had huge cuts to corporation tax that have really just kind of helped to initiate a race to the bottom globally. So, neither Rishi Sunak's proposals to balance the books, which is a big part of what got us into this mess in the first place, nor Liz Truss's proposals to cut taxes, which are not going to help the people that need most help, fill me with a huge amount of confidence that they're going to be able to do anything about this crisis. Really, what we need is a leader or, a prime minister or leadership within politics that is going to stand behind workers who are saying we deserve wage increases and say, yes, we should be coming to the table, or bosses should be going to the table with workers and giving them a fair pay increase. And rather than just kind of tax cuts for the rich, what we also need is some redistribution to protect those who are going to be facing big increases in their bills.
There's more on this story, as well as other news, interviews and analysis online at standard.co.uk. That's The Leader. Thanks for listening. We're back tomorrow at 4 p.m.